Hi, everyone. We're so glad you could be here today. Welcome. I'm Karen Tylick, Program Manager for Homegrown. I'm joined today by my colleague Vinette Pierre, who's the Digital Communication Specialist for Homegrown. And we're joined by our special presenter, Gary Romano of Civitas Strategies. Some of you may know Gary from the fantastic work he did supporting providers and accessing the PPP and other stimulus supports. And today he's here to help walk us through some thorny tax issues. So thank you for being here today, and we hope that this will be helpful to you. I'm going to pull up a polling question for you. We're curious to get a little feedback from you around what is your greatest tax concern for 2020. So let us know in the poll. And while you do that, I'll just share that everyone is going to be muted on today's call. So if you have any comments for us, feel free to put them in the chat. And then we're going to direct you to the Q&A bubble, should be in the middle of the bottom of your screen. If you have any questions for Gary around the content that he's presenting, putting that in the Q&A panel is going to be the best place to make sure that your question is answered. And then we are recording today's session and we'll be posting it to the website. So we wanted to make you aware of that. And you'll be able to refer back to it as needed throughout today's session. So thank you for joining us today to learn more about your 2020 tax preparation. And with that, I'm going to pass things over to Gary as we look at these poll results.
Excellent. Excellent. Great. Okay. A number of others. So hopefully as we go through this, you'll be able to, get the answers that you need. I think I will need participant screen sharing is what it says. I'm getting an error. Sorry.
I'll get that for you, Gary.
Yeah, thanks.
There you go.
Okay, awesome. We're in business. So what we'd like to talk about today is, as Karen mentioned, navigating your 2020 taxes. And as tax day, April 15th, is approaching us, I know many of us are wondering, what do we do? Because it has been an extremely unusual tax year. And what we're going to cover today is, how to prepare for your taxes every year, right? So there's some information that we're going to be providing that'll be good for you to be aware of, today, next year, or the year after that. These are just good practices and solid ways of doing things. The other thing we're going to talk about is the impact of the stimulus funding and kind of hitting some very specific types of stimulus funding that, as a home-based provider, I know that you've been receiving, and that you're likely to be wondering, how do I handle this on my taxes? We're also going to talk about how to find a tax preparer. We've been doing a lot of work with home-based providers in New Jersey, but also nationally, as Karen mentioned, with Homegrown, and so have gotten to know that a lot of you do have challenges finding a really good tax preparer. And so we're going to give some advice on some things you may want to ask about. And then finally, we're going to talk about some resources, and very specifically, and the website is actually in the chat box. We have a guide, a little step-by-step guide that includes places where you can put your calculations right in it, just like a workbook. That's available online in English and Spanish from Homegrown. So we'll talk a little bit about that, but know that there's another resource out there. So if you don't see it here, or if you want a place where you could write some of your answers to these things like expenses and such, it's going to be in that guide. So just as a quick reminder, why should we care about them? Because when we talk to providers, there are times where some of them, do kind of say, well, why should I be too worried about this? Certainly this is a basic responsibility. This is part of how we keep the government going. This is an important cost to be tracking as a business, right? You want to know what your tax rate is. You don't want to be surprised at the end of the year if you can avoid it. And this can also impact your eligibility for funding. So I know, as many of you experienced with the stimulus, for the PPP, we're asking for your 2019 taxes, and lots of people said, well, I never finished them, or I don't, have them handy, or some of those other things, and that affected eligibility, right? Because without those taxes, that was, and it still is, by the way, to be clear, a very key document, a crucial document, because you can't apply for this funding without it. And, to be clear, if your taxes are done right, this can minimize your chances of an audit and the costs associated with it, right? And I don't want anyone to freak out. Audits are not common, right? But at the same time, you do want to be ready. If you had to be audited, you want to make sure it's clean, right? That there's no question about how you prepared things. So let's talk just basically, because I know a lot of people have said, and you'll see this in the guide, we actually show you these sections of the Schedule C. So most of you are sole proprietors or you're independent contractors, and you do your business taxes through your 1040, through your personal tax return. In that, if you go about 3/4, 2/3 of the way through your personal tax return, all those documents you got back is something called the Schedule C. It'll say Schedule C in the upper left corner, and over the top of it, it'll say profit and loss from a business. So for most of you, you're going to be using the Schedule C is my guess. If you have an LLC, you might use a Schedule C. You might declare yourself as an S Corp, corporation, partnership. In those cases, you're using corporate tax returns. Though less common, right? It's good to know that all of those tax returns, whatever you are, whether you're a contractor, sole proprietor, S Corp, they all have 3 key elements. And again, you can see this for the Schedule C right in that guide I mentioned, in case you just want to be able to map it to your own. First, you report your revenue, right? This is all the money that came in from your business in a variety of ways. We're going to talk about what counts as revenue and what doesn't. Then, you show your expenses, right? Where'd the money go? What'd you spend it on, right? If you have W-2 employees, even if you're a W-2 employee, right, you put yourself down as an expense, right? If you're not a W-2 employee, you don't. But you'll have those expenses. And then finally, that amount that remains either is a profit or a loss, right? If you take all the money you took in, if you took in $100,000 and you spent $120,000, well, then you took a loss, right? You expended more than you had. You take it out of your savings or put it on a credit card or whatever. Conversely, if you had $100,000 that came in and you only spent 80, then you'd have a profit, right? You'd have $20,000 still left over. And that is what we then use to calculate your taxes. So let's talk a little bit about how to prepare. So first of all, let's talk about how much money you made. And in this part of it, we want to start with gathering your records, right? I know for many of you, if you are in your food program, a subsidy program, you're going to have 1099 forms that come to you. You are going to have bank records in some cases that you need to show payments from parents. For example, if you have cash payments, you may need to show your bank records for that. You may have some of your own documents, right? Year-end or weekly receipts showing how much was paid for care, right? And again, we have some useful worksheets in that guide that can help you organize all of this, right? So we have a little section where you put all your 1099s and who they were from, right? And any other payments. But you want to get these things together and then start filling out that sheet in the guidebook, because that'll help you have them all together. So when you go to your tax preparer, you're not just dumping a whole bunch of receipts, but you're able to say, here's what all these receipts and records are about. But you also, like we talked about, that second part of the tax form is about how much you spent. So again, we want you to collect your receipts if you have them, any sort of proof of payment, right? And so if you see on this right side of your screen, right? And by the way, in building the guide and in building this webinar today, we drew on a number of sources, but one of them in particular was the IRS, believe it or not, has an audit guide just for childcare. So we were able to build it off of this. So this information is literally coming from, in part, what the IRS would look for if they did audit you. And with an expense, it's critical to show first that you paid it, right? So a bill is good, right? I mean, it shows that somebody charged you for something, right? Like let's say an electric bill, but it doesn't necessarily prove you paid it, right? So some sort of proof of payment is important. The amount that you paid should be on it. So it's not good enough to just say, hey, Gary paid a bill for me, right? But it should say how much it was paid and when I paid it that date. And there should be some sort of description of what it is, right? Like, so you just don't want a receipt where I scribbled something and said, Karen paid me $500,000, date, right? But what was it for? If the IRS asks, they're going to want to make sure that was clear ahead of time. So those are the things that you want to look for as we talk about expenses, making sure that your records cover all of those things, right? And that may, again, be one thing, right? It might be a receipt that you get automatically from your utility bill that says, hey, Karen, you paid your utility bill for $433 on March 5th, and it was for the month of February, right, for your usage. So that would be just a simple thing. So don't overthink that right side, but be cognizant of it, be aware of it. And what I find is when we're working with providers, what can be very helpful is to methodically look for these expenses. Because a lot of times, this is not necessarily what's coming to mind, right? And you have often a limited number of ways that you're getting money, that revenue part, but expenses could be all over the place, right? It could be receipt from Target. It could be, something that you got at Walmart. It could be something that you got online from Amazon. There could be a lot of different sources. So what we recommend is do it methodically. Start by reviewing each of your credit card bills, right, for the year. Doesn't take that long, right? But just go through it. If you have a business credit card, this is certainly, of course, easier. If you don't, that's okay. What are those business expenses that you have where you do have that proof and you can justify it as being part of your business? Look at your app-based payment systems, Venmo, Zella, PayPal, Square Cash, any of them. There may be things that you paid for that, again, as long as you have these pieces of it where you say what you paid for and why and proof that you paid for it, right? That may be some expenses there too. And also look at your bank statements, right? Was there anything that you paid by electronic transfer or checks? And this will help you to systematically find all of those expenses. And what happens is as you accrue those expenses, that reduces, as we talked about, right? When you remember the tax form, starts with revenue, then we take off expenses, and then what's left is what you get taxed on. So, you want to be fair and honest about your expenses, but the more that your expenses are correctly and honestly reflected, the less money you have to be taxed at the end, which then helps with your bottom line. So again, the tax guide has a lot more information in it. And in fact, what we've done is we've broken it out by category based on your Schedule C. So you could even see in each category some of the ideas that you may have, right, for expenses. One thing I would say is, and the IRS has been very clear on this, and we're going to talk about it again in a minute when we talk about time and space, but you can include costs that are part of your preparing to reopen, right? So let's say Karen was shut down for 2 months and she now needs to restock all the snacks, right? And maybe she wasn't sure what was going to happen in the pandemic. So she got low on wipes and diapers, right? So she needed to stock all of that, even though she wasn't open yet, right? But she restocked all of it. Those expenses count, right? Let's say she needed, and this is an example actually from the IRS, needs to, she decides that, well, I'm going to be closed. I'm going to repaint my entire area that I use for childcare, right? Counts too, right? So keep in mind that some of those expenses, even while you were closed, if they were primarily for the business, they count. And again, same thing with time and space, which we're about to talk about. So do I include the cost of my home? Right? This is an important part of your business, right? Because you are a home-based business. This is a significant expense, right? It's a significant expense for you, a significant part of your business. And, if done correctly, it is, deductible, right? And what you're allowed to do is you're allowed to deduct a prorated, right? That means a percentage. It's a fancy way of saying percentage of your home and other related expenses for the parts of your home that are regularly used for care, right? So let's talk a little bit about the elements of this, because that's a lot to throw at you, because even though it's just a couple of sentences, there's a ton in there, right? So number one is, you know, the fact that this is something that's regularly used for your home. And what I would say is as you think about the space, right? As we see, this is the amount of physical space, usually it's in square feet, that is regularly used for care. One of the things the IRS says in their audit guide, which I think is a wonderful example that they put in, is that we often think of that as being the main room, right? So let's say you have a main room that you're using for your care, right, in your house. But what they also say is it could be other rooms that you regularly use, even though it's not all day. So, for example, the example they give is, let's say you have 3 kids, right? And if you had the same experiences I did with young children, with my boys when they were young, you need to separate them at nap time. so, so let's say you need to separate them at nap time. This is an example. So one stays in that main room, and then let's say 2 other bedrooms in your house are used by the other 2 children, and it's just during nap time. The IRS actually very clearly says that is considered a regular use. They're using it on a regular basis. So that area of the home counts as well, right? So, we want to be careful about, once in a while they're allowed on the second floor of my home, so I'm going to write off the whole second floor, right? But on the other hand, if your regular use does include the entire home, and I know for some of you it does, that is allowed, right? So you want to be able to have some sort of justification for that regular use. If you want to, and it's not a bad thing to do, you may even want to write kind of just like a little letter to yourself and say, here's why I included this square footage, because we always use this room in this way. I put the kids for napping in these other rooms as well, right? This happens too. So one part of it is space. How much of your house are you using? The second dimension we're going to talk about is time. And I always feel a little bit weird talking about space and time. I feel like it's Star Wars or something. But when we talk about time use, this is how much you're regularly using your home for care, right? So if you are typically open 8 hours a day, right? You do 8 hours a day times 5 days a week, right? Times 52 weeks, that's the number of hours. Um, do know, right, that you do have the option of actually using, and the IRS has clearly said you could use either. You do have the option of using your actual hours. So if you keep a log every day of when you open and when that last kid goes, you can use that instead, right? So you could either use an estimating method where you say, I'm open approximately these hours every day, or you can say, I have logs that say these were when I was open. And again, those don't have to be like special IRS logs. It could just be, I keep track of the hours the kids are here so I can figure out exactly how many hours I was open. Again, as I mentioned just a few minutes ago, the IRS has also made it very clear that the time you use preparing your space for opening counts, right? So again, if we take the example that Karen had to repaint that great room she's using, where all the kids play and everything else, that time would count. She could log that time as being part of the time this year. Because again, I know a lot of you had very truncated years in terms of the amount of time you were open, right? It wasn't every week. So it wasn't like 8 hours a day times 5 days a week times 52 weeks. So this will help you get a little bit more time towards that calculation. Again, keep a simple set of notes around it, around why you're saying it's the amount of time that you're saying it is. You don't want to just freewheel it. You do want to have something just in case you're audited that you're able to say, here's what I was thinking. So again, if you go in that guide, you can actually write all this down. But I just want to kind of go over an example of the time space calculation because I know it's really important to many of you. And if we have in this example, provider uses 500 square feet of her 1,100 square foot home regularly for care. So first thing we do is we get the percentage of the home that's used for childcare. So that's 500 divided by 1100. That's 0.454 or 45.4%, right? So that's whoops, space. Now we go to time. So you take the hours per day, days per week, number of weeks, right? Any hours that you were closed, add those in. That's the total number of hours that your home was used for care, right? So again, in our example, our provider was closed for 4 weeks. During that time, she worked to maintain and prepare a facility for 10 hours, right? And some examples, by the way, from the IRS are things like repainting, restocking supplies, right? Maybe you decided to rearrange the whole layout because you didn't have all the kids around for once, right? It all counts. The remaining 48 weeks of the year, she used her home 12 hours per day, including both caring for children and cleaning up. And that's another element, by the way. It's also, that care and prep is not just for when you were closed, it's every day. So if you spend an hour a day at the end of the day cleaning up, and again, if the kids that you're caring for were anything like my boys were when they were young, I'm sure there's an hour a day that you're spending cleaning up. And so, or more. And so if that's the case, that time does count. So again, when we talk about regularly using for this business, it's not just when a kid was on site, to be clear, but it was when you were doing activities related to your business. And so in this case, right, we take this calculation. Sorry, my headset went dead. 12 hours a day, 5 days a week, 48 weeks, plus the 10 hours that she had in preparing. It's 2890, 2,890 hours. Divide that by the total hours in 1 year, right? Because in fairness, right, there are hours that your house is being used only exclusively by your family. That's 329.329, excuse me, or 32.9% of her time. So now how does that all come together? Now we have time and space, right? So again, we take those two percentages. We take the first one, which was space, we take the time, multiply the two together, and we find out that 14.9% of those home expenses are deductible. So to be clear, by the way, when we talk about those home expenses, what we're talking about is expenses that were indirectly related to the business, right? So let's take the example that we had before. The paint that Karen got where she was painting the walls, that's a direct expense, right? She got that for the business area. That's directly expendable, right? So if we go back to how much did you spend? That receipt from Home Depot or Lowe's or your local True Value, right? That would go off of an expense there. But let's say she decided to repair the stairs going up to her house, right? Well, the kids benefit from that, but so does everyone in the house, right? So that's more of a general expense. Or if we take the electricity that you used, right? During the course of a year, well, some of that was for the business, some of it was for the house. It's really hard to say exactly how much was used for the business. So you use this percentage, right? So Karen would be able to say, I paid $1,000 last year for my electric bill. I get $149, right? So 114.9%, right, of that money, but then becomes deductible as a business expense. And again, the guide not only has this information, it also has a link in it to a spreadsheet. So if you just want to be able to plug in the numbers and have it do the calculations for you, we have you covered. So let's talk about, I know many of you have been wondering about stimulus funding. How is it going to affect things this year? So what we've done is we've broken these out. And again, there's more information in the guide. And I'm covering some things here that are personal and may not be part of your business, but I know they're on top of your mind. Karen was kind enough to share the questions that you put in registrations. We want to make sure we answer those. So let's start with some of the things that are more personal to you, right? So stimulus checks, if you got those $600 stimulus checks, right? Those are not taxable. They should not be included. They're not part of your business, to be clear, right? But they also shouldn't be included as part of your personal taxes. Unemployment. I know many of you were not only unemployed, but for part of the year, but you also had to take PUA. That was the personal unemployment assistance. So that was for people who are normally on a 1099 or self-employed in some way. And normally you don't take kind of traditional unemployment because you're not a W-2 employee. This should be reported as income, as personal income. So this isn't part of your business. Don't put on that Schedule C. But it does come in as being part of your personal income and is taxed. Another thing is I know many of you received in-kind donations to your business. So, maybe you went to your local CCR&R and you picked up a number of packets of diapers or wipes or masks, right? Technically, there's no tax liability for those. You don't need to report it. You don't pay taxes on it. But some of you, especially if you're a nonprofit, consult with your accountant just in case. Let them know about it at least. But there should be no tax liability there. Stabilization grants. So within stabilization grants, and now we're starting to get into some of the stimulus cash that you got, right, for your business. So a number of states I know provided money that came down from the federal government, from the state for stimulus through stabilization grants were often what they were called. There were other grants that you may have gotten one from your economic development authority. You may have gotten one, your local CCR&R may have been doing part of it, right? But these grants in general are included as income for your business. So on your taxes, that first part that we were talking about, the money you made, it would be on there, right? So just know that unfortunately, and I know that's been very um, disquieting for many of the family care providers I've talked to because they weren't anticipating that. But unfortunately, it is. Um, Similarly, if you got additional subsidy money, or if you supported emergency workers, and I know a lot of states paid a premium for that time and give you a little extra money again, those need to be included. Very often, it's already rolled into the 1099 you're getting from your CCR&R. So you may already have it in that 1099 that you've received, but you know, do know that you will have to include that money as well as part of your revenue. Paycheck protection program. So as Karen mentioned, this is something we've been helping with providers around the country. This is one that gets a little weird. So the good news is on your federal taxes, you don't put this down. It doesn't count. The debt doesn't get taxed. When it gets forgiven, it doesn't get taxed. The things you used it for are still deductible. So to be clear, right? Um, there was a question at one point as to whether it would be. But what that means is, let's say I used part of my PPP loan for, to buy some masks, right? Because you now can. So let's say I bought $100 of masks. I can still, even though the PPP money doesn't count as revenue and kind of disappears, I can still count that $100 off my taxes, right? This is many of you will say, well, that seems a little weird. It feels like you're double dipping. You are double dipping. It is, quite widely known, right? And the government has said otherwise it's going to be insane. So we're letting you do that. So you can deduct things you paid for and bought with it as long as they're legitimate business expense, right? Of course, they should be if you're using the PPP money on it. You can deduct those off of your taxes, but the PPP revenue, the money you made from it, does not get counted. However, see this little asterisk, right? At the state level, it's a little bit different. A number of states have already said, we will not be taxing this. Like, for example, the state of New Jersey has said, we're not going to touch it. We're going to be like the federal government. Others, like the state of Massachusetts, are still deciding. Other states have decided that they will tax part of it, like either they'll tax the forgiveness or they won't allow you the deduction. We have, as of the past few days, we do have a current state list in the tax guide. It's worth checking out. Check your state so that you can be prepared for that, because some of you may be surprised. Like Virginia's been talking about potentially keeping that tax in there, and some other states. You don't want to be surprised when your tax preparer comes back and says, "Hey, Gary, you weren't anticipating this bill, but here you go," right? Um, so do definitely keep an eye on that. If your state is one of those ones that's not taxing it, good to go. If your state is one of the ones that's taxing it, I would keep an eye out. I'd follow the news because what you may find is that that they change their minds on it. There's of course a lot of pressure from small business not to tax it. Economic injury disaster loans, other small business loans, right? The EIDL advance, so that money that some of you got that was the grant money from the EIDL, the free money, don't, like the PPP, don't put it down. The loan, any other SBA loans you got are traditional business loans. So you can deduct the interest, right? So if I pay, let's say I paid $5,000 on my loan in 2020, and of that $5,000, $500 was interest. Well, the $500 I can deduct the interest. The loan itself, the principal that I paid, the other $4,500 I cannot. Finally, Families First Coronavirus Act leave. Many of you have seen me talk about this program. I think it's a great program. It gave you a tax credit, still does, by the way, through the end of the month. It gave you a tax credit for coronavirus related leave, quarantine, and also taking care of your children, who were out of school or on remote school. The details are in the guide. We also include a little sheet on there because you can then fill it out and bring it to your tax preparer, which explains how they should report it. This is a tax credit. So in other words, this one's a little different than everything else we've talked about because this happens at the end, that third section where you have your tax that I mentioned on your tax form. So if, let's say, Karen owed $100 in taxes and then she got a tax credit for $500 through Families First, well, she'd get $400 back because it would take care of her tax and then some. If, let's say, she was getting back $200 and she had those $500 from the Coronavirus Act, she's now getting back $700. So you can see where this adds up. Take a close look at that one in the guide. This is a great program. A lot of people don't pay attention to it, but as you can see, it can add up. And now's the time to do it because as a sole proprietor, you do this as part of your taxes for the year. So definitely take a look at that section. If it's appropriate, fill out that form, bring it with you, and let your tax preparer know that you're eligible. Speaking of which, let's talk about how to find a tax preparer. Just a few questions to think about, right? Are they qualified, right? Ask what their qualifications are. Remember, this is an important thing. Like we talked about at the beginning, right? Something goes wrong, the government's looking at you, right? So you want to make sure this person is qualified. Ask what qualifies them, right? What's their history in tax preparation? What's their experience? Are they available all year round in some way? This is a really important question as we found out, unfortunately, in the stimulus work, right? Because what we would have is we had a lot of people who didn't hold on to their taxes or had a question about them that came up as they were applying for the PPP or other stimulus, and they couldn't get in contact with them, right? Because this wasn't their full-time job and they weren't really open and blah, blah, blah. It's good to know, like, if I need something on August 25th, can I get in touch with you? How would I get in touch with you? Do they have a clear upfront fee schedule, right? You should know how much you're paying upfront, and that's not an unfair question to ask them. And if they say something like, well, it depends on how complicated it is, no, you should talk about that upfront. You should know how much you're going to pay. You should also know what they do if there is an audit. Again, ultimately you're responsible for your taxes, but many times you can buy audit insurance, or a tax preparer will say if you are audited, we include that in our cost, we'll help you. It's good to know those things, right? And you want to know how much time it's going to take, right? Because you want to know when it'll be done. If you're going to get a refund, you certainly want to be able to budget for that. And certainly you want to know how to get a copy of it. And we're going to talk more about that in a second, but it's absolutely critical that you retain these documents. Really, really important. You know, as much as we're talking about in person here, as we suggest on the side, don't forget about online tax programs. They've gotten a lot better over the years. They're a lot easier to use. I know many of you are not comfortable with technology, but many of you are, right? So this can be a great way to be able to do your taxes individually and personally, and also, frankly, save a little bit of money. And some of the systems can be quite good. So don't forget to look at them if you're thinking about, that you may be comfortable enough to do it. Take a look at some of the software that's out there. So Now that everything's completed, you've gone through your taxes, you got your preparers, you finished them, right? Here's what I want you to be asking for and to be keeping, right? Records of written confirmation that your state and federal taxes were submitted, right? It should be something that said these definitely went through. If they did electronically, they got an email, they got some sort of confirmation that said it. You want a hard copy of your tax return and any of the associated documents. You want to retain those. And I know many of you say to me, gosh, but I've known Jerry for so many years and he does my taxes. That's great, but you never know what's going to happen. And if, gosh forbid, Jerry's storefront goes and burns down or something happens, now you don't have your taxes. And that becomes a huge pain, huge. So do know that you should have a hard copy. If you can get an electronic copy, get one too, get both, right? You want to have both. And certainly ask for all those original documents back. Sometimes people get so excited. They go, "Oh, I'm getting a refund. I'm so glad. Okay, I'm heading out now." And they don't take back all the stuff they gave the tax preparer. Well, all of that, as we've been talking about, that's evidence if you're ever audited that you did the right thing. Make sure you get those, right? And hold on to them, as it says at the bottom, hold on to them for 4 years at least. If you're a pack rat like I am, you may want to hold on to them longer. But I want you to at least hold on to them for 4 years. After that, you can shred them, burn them, whatever, but hold on to them for at least 4 years for me. So if you need help, as you saw in the chat box, there is a homegrown guide that we've helped create. It's in English and in Spanish. It has all the information and more that we've presented today, as well as some little worksheets that you can put everything in. So it'll really help you organize. So with that, why don't we open up for some of your questions?
Okay, great. Thanks, Gary. So much important information in there. And I'll just say, if anyone has additional questions, please feel free to put them in the Q&A now. We do have a decent amount of time to answer some questions, and it helps us to track it if it's in the Q&A as opposed to the chat box. All right. So, Gary, you went over some of the allowable expenses, and we have someone who's listed a healthy list of additional expenses. I just wanted to run these by you really quickly. So, and this person said, I was told that we couldn't use our grant on regular bills. So here's a list of some of the things that they did: ceiling fans for better circulation, humidifier to put moisture in the air to avoid sickness, oils, play equipment for outside, um, bubbles for the backyard, and even sod to put down on the ground for the backyard play spaces. Can you speak to whether those are all allowable expenses?
So in terms of allowable expenses, yes, in that they are in your area of business, right? So again, just to be clear, if I put in a ceiling fan in my bedroom and the kids never go into my bedroom, not allowable, right? If it's in that main space or one of the spaces you're using, like as we said in that example from the IRS, let's say there are two bedrooms. Let's say I do use my bedroom from time to time, every or not time to time, excuse me, every day on a regular basis. One of the kids takes a nap in my bedroom, and I like to have that fan on for them. Then yes, that would be. It sounds like part of the question is it also compliant with the grant money? That I don't know. A lot of the grants that came down from your states had different requirements. So I want to be cautious and want to make sure, just in case you are asking that part of it too. I don't know. But if you're not, yes, deductible.
Great, thank you. So speaking about grants, Kim says that she qualified for two grants. She received a 1099 for one of them, but not for the other. Do you have
Okay.
advice for how she should proceed at this point?
So, you know, I actually was talking with a provider about this just last week, right? I will give you the exact information that I received. Um, One grant came through the CCR&R. She got a 1099 for it, right? One grant came through the state of New Jersey, just to name it. This is all public information, right? Came through the Department of Economic Development. She never got a 1099 for it, right? So the question was just like this one, what do I do? I ended up, because nobody seemed to know if she was going to get 1099, I actually called them up and they said no. and they will not be issuing a 1099. That's odd. As I told the provider, that's not necessarily typical. But at the same time, say in New Jersey, it's what they've decided to do. So there you go. So in other words, you may not get a 1099. That being the case, I would still report that income because it is reportable. So if the IRS comes, just because you can get a 1099, you can't point to the state of New Jersey and say, they didn't give me a record for taxes, because the IRS could say, but they gave you the money.
Thanks, Gary. Okay, so from not enough 1099s to too many 1099s. So we have a question that says, we provided service for state approved children and received both a 1099 miscellaneous, MISC, and a 1099 NEC. They're for the same amount. Why did we receive two forms for the same service? And how should they proceed?
So I'd love to see them to make sure they were for the same service and not some sort of proration. The miscellaneous did change this year, for a variety of reasons. The IRS now has two different 1099 types. I wonder if there was some confusion with that. I would confirm with either through your records or with the person who paid you what the correct amount is. Because my guess is that somebody sent out a miscellaneous when it should be an NEC or vice versa by accident, and didn't send you a letter saying it was a correction. But make sure it didn't, for some reason, because of funding reasons or something else, they didn't split them.
Great. Thanks, Gary. All right, we have a question about small business grants. So this one just says, how are small business grants taxed?
So it depends on the small business grant, right? Most of them are going to be taxed as revenue. If it's a PPP and that's what you're referring to as a grant, technically a loan, it is not taxed. The forgiveness is not taxed. You do not report it. Period. Right? But that's the general rule. So generally, you are going to be taxed on them. If it is a PPP, you're not. If it's an EIDL, the grant part of it, nope. Right? That up to $10,000 that you got, and those of you who are getting in on the targeted IEDL right now, that part does not get taxed. The debt doesn't get taxed either, right? Because the debt is a liability against your business, it's what you owe, but you can deduct the interest that you pay on that.
Thanks, Gary. We have a couple of questions about leave. So, one question asks about the coronavirus family leave. Would this have been something that you pre applied for and pre approved, or is it a tax credit that you can take out? And then another question says that this provider had to close their childcare center. The health department ordered them to close. Because the children were sick. And so the provider used a sick day to be paid. Can the provider apply to get pay through the Relief Act? And if so, where do they apply?
Okay. So the great questions, right? Let me talk about how Families First works. Families First was created so that small businesses like yours, right? And it goes from an individual all up to people with hundreds of employees that are still a small business, to give them the chance to be able to provide leave during the pandemic that might be needed. So there's two components, and I know it's going to be a little lengthy, but bear with me. Component one is you can take up 10 days if you get coronavirus or if you're quarantined because of coronavirus, right? So real life things, right? Many providers got corona, up till now. Many other providers, like I was talking to a provider last week, back in November, mom came in and said we had an exposure. Everyone had to shut down, right? The whole operation had to shut down appropriately, right? But that was 2 weeks where the provider was not making money, right? So that would count as a quarantine, right? Because she had to do it because of her legal obligations. So that's component one. You can also use those 2 weeks if you need to care for somebody in your family who has corona, right? Your spouse, child, you have to take that time off. That can count as well. The second component is up to 10 weeks for family leave. Now, the way this was originally envisioned was that this was because, as many of you know, childcare centers closed, right? Schools closed, and your life had to suddenly stop. And, either you had to take care of your child or you split it between you and your spouse or whatever combination you had, but there was lost work time in caring for your child and helping to homeschool them. So that time counts for family leave. Additionally, as things started to open up again, the IRS put the caveat in that it can be used intermittently. So, for example, I know of one provider who every Friday on their rotation, she's taking care of their child for homeschool, right? Because the child's in a hybrid environment. So, part of the week is in school, part of it's at home. That counts. Snow day does not count, right? The rule of thumb is it is a normal school day, but they can't be in the building, right? Or the child is home, like, one provider, their infant's daycare closed indefinitely and there isn't another one in the area, so she's home with the child. Those things can count. What happens is if you have that first group, right? So if you had corona or you had to quarantine, you get 100% up to $511 of your daily pay, and that's calculated off of the money you made at the end of 2020, right? If the leave was taken in 2020. For all the other cases, it's 2/3 of that number. So you can see where you're going to need your tax preparer, right? The way you do it is this is actually a form that is part of your tax preparation. Just like your tax preparer does the Schedule C, she'll do a family's first leave form, right? That's why in the guidebook we have a little piece of paper that'll help them, because some of the tax preparers don't know or they're not sure. And we have on there, tax preparer, this is what this is about. You can bring, this is the form in the 1040 that you're supposed to fill out with it, and here's where it ends up on their tax return. So it's not that you apply. We want you to bring that information to your tax preparer. By the way, if you're doing online taxes, QuickBooks, or not QuickBooks, I'm sorry, TurboTax. I don't know why it's the QuickBooks version of their tax, or H&R Block. That's the other one. They both have it in the system, so you could use it within their system online as well. So that's how you do it. It's nothing you have to apply for, but it's a record keeping thing. And again, keep in mind those limitations.
Thanks, Gary. So speaking of record keeping, someone wanted to clarify how long they need to keep their tax records. And does that mean that the IRS will go back no further than that time period?
So yes, I mean that is correct, right? So you're holding on to the taxes for 4 years because that is what the IRS says to hold them for, right? So they don't typically go back 5 years, for example, to audit you. What I would say is, if for any reason you had something extraordinary, keep them a little longer. If you ended up changing them, like for example, years ago, I had found out the tax preparer who's doing my mom's taxes was not doing an adequate job. And so I ended up revising some of her taxes from years before. I then held them onto them from 4 years from when I revised them. So even though they were already 3 years old, I held on to them for another 4 years because I wanted to make sure that if somebody came back and wanted to audit the changes I made officially, that they were in there. So hopefully that makes sense.
Great. Thanks, Gary. Um, okay. How about the interplay between family leave and unemployment? Are we able to speak to that in terms of taxes?
So family leave and unemployment, right? So family leave is considered to be time off from your business, right? So you can't really be on unemployment and taking family leave from your business at the same time, right? Because you're saying over here, I'm not working, my business isn't open. And then over here, you're saying it is. Now, what the law doesn't say is that you can't have both in the same year, right? So, for example, we had providers who said, I'm not sure if I'm going to stay open, but right now I have to take care of my kids at home. I'm going to have to use this family leave time. They waited like 4 or 5 weeks. Then they realized they weren't going to be able to make it. They went on to unemployment, and then they came off unemployment and maybe ended up on family leave again. That's okay. right? So you can do some of those things or do some of those things as well. But what you don't want to do is to say, I'm unemployed and on family leave from work at the same time.
Great. Okay. And you spoke to this a bit earlier, Gary, but can you talk again about the when it's a federal decision regarding what's taxable and when it's a state decision regarding what's taxable?
Yeah, I mean the big difference this year and any year, because typically the states are in lockstep with the federal government. Some of the small differences you'll see is sometimes the states will give you a different credit, right, than the federal government will because they want to incentivize something, right? Like maybe if your business is in a certain geography or something like those lines, or maybe they're giving you an extra tax credit for renewable energy because you put solar panels on the roof or something. Um, but typically they're in lockstep. In this year only, it's a big difference for some of the states in the way they're handling the PPP. Because in some states, what they're saying is, because again, the federal government, we're saying the money coming in isn't taxable because it's a debt. When it gets forgiven, normally that would be taxable. The federal government has said, nope, not going to tax it. It's a tough year. And then if you're not taxing either of those, you usually wouldn't get the deduction of what you spent it on. And so what some of the states are saying is they're either saying all of them agree you can't tax the debt. Some are saying, well, we can tax when you get forgiveness because that gave you money. And even if the federal government isn't doing it, we're going to do it. And some are saying we won't tax the debt, we won't tax the forgiveness, but we're not going to let you take it as a deduction. So anything you spent it on, you can't then take off your taxes further. So that's where it gets a little hinky. And I want to say it's 17 states right now that are looking at different ways of potentially taxing it. So again, look carefully at that list and keep up to date because it is changing.
Great, thank you. And so again, that list is in the guide that we shared in the chat. So Gary did his best to stay up to date on information. Gary, since that information does continue to change, do you have a recommendation for folks as to where they can make sure that they're working with the latest info?
I mean, I would generally check the news. Your local news sources are really keeping up on it. This is a really big important issue. Your local Chamber of Commerce will be keeping up on it as well. The US Chamber of Commerce, if you follow them at all, is keeping up on it. And certainly in some cases your CCR and ours will as well. So, as you get information from those sources, keep an eye out for it.
Great. Okay, well, I think we've addressed most of the questions in the Q&A. Um, and we have certainly learned a lot to digest here. So again, we will refer you to the guide that we've linked in the chat. We will also be posting the recording of this webinar to that link. And we'll be emailing these resources out to everyone who registered likely tomorrow. So Gary, any last words of wisdom for folks as we wrap up?
I just, take it slow, right? Definitely go through methodically, right? Your taxes are something I know a lot of you, it's like that band-aid, you want to rip it off and just get it done with slowly. Unfortunately, even if it's painful, get it done right.
Great. Thanks so much. Well, thank you everyone for joining us today, and huge thanks to Gary Romano for sharing his expertise with us.
My pleasure.
Thanks everyone. Take care.
Take
Bye,
care.
everyone.